Picture a dynamic young nation in the early part of the 20th century. It's already one of the 10 richest countries in the world, and its surging economy, fueled by exports of wheat, beef and other commodities, promises to overtake its European forebears within a matter of years. Lured by this promise, thousands of Irish and Italian immigrants are flocking to its shores to seek their fortunes in this new world. If I asked you to name this country, you'd probably say the United States of America. In fact, the country I'm describing is Argentina. In the early part of the 20th century, Argentina and the United States shared several striking similarities in their socio-economic trajectories. Both nations experienced a period of robust economic growth and expansion during this time. Argentina, often referred to as the granary of the world, enjoyed a booming agricultural sector and became a leading exporter, mirroring the agricultural prosperity seen in the American Midwest. Furthermore, both countries attracted waves of European immigrants seeking better economic opportunities, contributing to a diverse and growing population. The urbanization and industrialization witnessed in both Argentina and the United States led to the rise of vibrant cities and a burgeoning middle class. Now, let's compare the countries in 2023. The US is the global hegemon. Its massive economy is 5 times larger than all of the countries of South America combined. By contrast, Argentina is now synonymous with defaults, hyperinflation, and a series of bailouts from the IMF. Its economy recently edged out tiny Belgium to be number 23 in the list of countries by GDP. The divergent fortunes of Argentina and the US serve as an important parable for investors. It's very difficult to predict which countries will be successful and which will not. If you had asked a passerby on the street 100 years ago if he should invest his money in the US or in Argentina, he would have been as likely as not to have chosen Argentina. Similarly, in 1989, Japan was viewed as an unstoppable financial juggernaut out to eat America's lunch. Japan Inc. was outcompeting American companies in many industries, including automobiles, electronics, and steel. Most experts agreed that Japan would soon become the world's largest economy, and the Japanese people agreed, putting all of their money into domestic stocks and real estate. Unfortunately, within a year the bubble had burst, and Japan faced decades of stagnation and decline. It's only in hindsight that we can see how important international diversification can be. Many of us have what economists call a home country bias. This refers to the phenomenon where individuals tend to favor investments in their own domestic market over foreign markets. In other words, they show a preference for investing in companies from their home country. This bias can be driven by several factors, including familiarity with the local market, perceived lower risks in domestic investments, and a sense of patriotism or nationalism. Investors may feel more comfortable investing in companies and industries that they're familiar with and believe they understand well. They may also believe that they have better access to information and resources in their home country, which can lead them to favor domestic investments. Home country bias varies by country. One of the most striking examples is in India. Although its stock market represents a tiny 3% of the global market cap, investors in India have almost 100% of their portfolios in Indian stocks. Now, having a small home country bias can sometimes be a good idea because it helps to reduce currency risk. When you invest in foreign assets, changes in the exchange rates can impact the value of your investments. For example, if an investor in the US owns Japanese stocks and the Japanese yen suddenly strengthens against the US dollar, the dollar value of that stock will fall. However, for long-term investors, currency risk should not be seen as a reason to avoid international stocks. This is because over time, exchange rates tend to balance out. Eventually, businesses and consumers will adjust their behavior to take advantage of arbitrage opportunities. For example, if the US dollar is overvalued relative to the Japanese yen, Japanese businesses will be able to export their goods to the US at a lower price, making them more competitive. This will in turn increase demand for the Japanese yen and cause it to appreciate relative to the US dollar. So, what percentage of international stocks should you be holding? Well, for US investors, Vanguard recommends that around 40% of your stock allocation is international. And that's because the US currently represents 60% of the global stock market. An easy way to do this would be to own a mutual fund or an ETF which owns some stocks from all countries. If you click on the link below, you can see some of the most popular and cheapest options. These days, it's common to hear views like international stocks are trash or American companies will always outperform foreign ones. These opinions are obviously short-sighted and can be disproved easily by looking at historical data. The evidence is pretty clear. Owning at least some international stocks in your portfolio is likely to be a smart move and could even prevent you being long the next Argentina.